Thank you everyone for joining us today for the biggest legal and business, the biggest legal and financial mistakes that business owners make. Today I have with me Noura Almasri, who's an accountant. She's been practicing since 2003 in both profit and nonprofit sectors. And I'm so happy to have her with me. And of course, I will be talking about the legal business mistakes that business owners make. And if you don't know me already, I'm attorney Danya Shakfeh. I've been practicing business law for over 10 years. And we'll just get into it. And here we go. So I'm going to share my screen so that everyone can see our slides. All right. Okay, so as I said, this is the title of this presentation is the biggest legal and financial mistakes that business owners make, and I will be doing the legal aspect, and then Noura afterwards will have her presentation about the biggest financial mistakes that business owners make. So the first mistake is not having a proper business setup. And it really is about having a proper corporation. And sometimes, business owners choose the wrong entity. And I will talk about the different types of entities. But first, when we talk about business, what is a business? There are different types of ways that you can have one. First, you might have heard you can be a sole proprietor, which is you don't have a corporation and you're individual doing your business, and your finances are they are the same as your business. Your personal business finances are the same. You don't really operate you personally do not operate separately from your business, and that's called a sole proprietor. Most sole proprietors have something called an assumed name, and that depends on your jurisdiction. Some counties actually require that if you have a business that's non-incorporated, you get it, what's known as a DBA, which stands for doing business as, and it's also known as assumed name. And again, this will depend on your jurisdiction, and it's just really a name for your business. You can't say corporation or LLC in that situation because you're not a corporation or an LLC. And there's no liability protections, and the tax benefits are very limited. And I know Noura can talk more about that when we get to that section. And of course, lastly, is having a corporate entity. And this is probably most, people mostly do this, but I've seen a lot of businesses who have been in practice for a very long time, who actually don't have a corporate entity. So those are 3 different ways that you can have a business. And again, the first mistake is not having the proper business set up. Like I said, to not incorporate at all means that you will that your personal assets will be open to creditors. So for example, if you have a building and then a customer comes into your building, falls and gets hurt, then you could personally be liable in the event that customer sues you, and they could go after your personal assets. But if you have a corporation, you can actually separate your personal and your business assets so that the customer can only attach to the corporate assets. Another mistake is choosing an LLC instead of a corporation, or a corporation instead of an LLC. It's a very personal decision that you make with your attorney and your accountant, because there are legal and financial ramifications for each choice. So that's that first mistake. And as I said before, the benefits of incorporating instead of being a sole proprietor is that you get liability protection. There are, but if you are a professional, you do not get malpractice protection, but all other types of protections you do get. And then of course there are the financial benefits, as I said, like asset protection, and you also can build your own credit because you get a separate tax, you get a separate tax ID, and over time you can use that to get a line of credit, or another type of business loan. Lastly, to get a corporation, the last benefit is that people just see you as a more credible business. They take you more seriously. And if you ever want to sell your business, it's easier because because the business is a separate entity. It's not attached to your personal assets. And of course, if you ever want to grow, it's also easier because your business assets are separate from your personal assets. So what are the types of entities? If you want to choose a corporation, if you want to choose the right type of entity, it's good to have an idea of the 3 types of entities. The first one is a limited liability partnership, or an LLP. They're not used as commonly anymore because the protections are not the same as corporations, and also the tax advantages are not the same, but it's still an option. But most commonly, you'll see businesses use corporations or LLCs, and I'll explain the differences between the two. So corporations, they are governed by the Business Corporation Act of 1983. I'm not going to get into too much, into detail about the statute, but a lot of people confuse what the names of the owners of each type of entity. So in a corporation, the owners are called shareholders, and corporation has bylaws, and they have the shareholder agreements. These are the documents that govern a corporation. The ownership units, they're called shares. So I have a lot of business owners who have LLCs. They come to me and say, well, so-and-so has X amount of shares, but shares actually only apply to corporations, not to LLCs. And I'll talk more about that when I get to the LLCs. The benefits of a corporation is that it's like generally good if you want to have outside investors, and it's designed to spread the control and the accountability of the owners, because because you have officer, board of directors, and so there's more spreading of liability and decision making, whereas an LLC is more of like a partnerships, and they tend to be smaller. The cons of a corporation is that you have more corporate formalities, meaning that you have to follow more rules if you want to keep the protections of the corporation. As I said before, if you have a corporation, then you have the asset protection in the event of a lawsuit of some sort. And you could also be subject to like double taxation in the corporate setting, just depending on how you set that up. And of course, if you have an accountant like Noura, she can tell you how not to be double taxed. There are ways for that as well. So the corporate structure, like I said, it's designed for a lot of people to be involved. It's not really designed for one or two people. So you have the shareholders who own the shares. The shareholders appoint the board of directors. The board of directors appoint the officers. The officers report to the board of directors, and then the board of directors are accountable to the shareholders. So you can see if you have just 2 people, then you're kind of just being accountable to yourself, or like voting for yourself, and it's just not, you can see it's just not, conducive to, just 1 or 2 people. So when you're choosing a corporation, you want to keep that in mind. And of course, you talk to, your professionals to get the right type of corporation. Now, partnerships, this is a little bit more, so like if you're a smaller group of people where you want to put the control more closely into, like with less people, more of a partnership style, then you could get a partnership. There are different types of partnerships. Again, I'm not going to go too much into detail, but obviously the owners of a partnership are called partners, and the the governing agreement is called a partnership agreement. Not legally required though, but it's better always to have one. The ownership units are actually called equity. So you could say I own equity in the partnership. It's not shares. The pros of partnerships is that it's a less complicated structure. You don't have, like the board of directors and shareholders nominating this and doing all that. So and then there are ways to have some protection, but it's not as much as a corporation or an LLC. And the cons of a partnership, again, not as much protection, and you have a lot less tax flexibility. Now, in about 1993, Illinois actually adopted something called a limited liability company, which is basically a merger of corporations and partnerships into an LLC. So basically, an LLC is a corporation partnership hybrid. And they are probably my favorite corporate entities. They're kind of my go-to in most instances, especially for smaller businesses. They are governed by the Limited Liability Act. The owners are called members, again, not shareholders, not partners, but they're actually called members. And the governing agreement is called an operating agreement. So sometimes, business owners come to me, they have an LLC and they say, well, here's our contract between, the partners, the members of the LLC, and it's not called an operating agreement. I've seen all types of wrong contracts. So if you want to have the proper document, it's going to be called an operating agreement. And there are certain elements to an operating agreement. And the ownership units are called interest. The pros, there's a lot of pros. Basically, you can tailor an LLC to almost any way that you want, which is wonderful if you know what you're doing. A lot more tax flexibility. The cons is, the LLC is mostly that it's not that great if you are looking for outside investors. You have to know what you're doing, like to set it up properly. But if you're looking for like venture capitalists, probably a corporation might be more suitable. But otherwise, generally, LLCs can work in pretty much any situation. And there's two types of LLCs. There's manager managed and member managed. And it just really depends on how you want to structure your business, which members have a certain amount of authority. If you have a silence, like business partner versus someone who's active in the business, you can choose between the two. And so, it's like just going back to the mistakes is basically that you have to have some level of understanding of corporate structure so that when you start a business, you have you don't just say, okay, I'm going to have a corporation and then not knowing that there are other options. Now, one common mistake too is that a lot of business owners don't know this concept of corporate veil. As I said before, when you have a business, you have a corporation or an LLC, you get asset protection. And that asset protection is contingent on you following something called corporate formalities. So typically, corporate formalities mean that you have that you separate your business financials and your personal financials. So, don't buy your car on your business credit, for example, or don't, go, on a shopping spree for personal goods, on your business credit card. A lot of people do that thinking, oh, that you can just expense it. But not only is that a tax problem, it could actually create a legal problem. Also, having the right documents, that's also a corporate formality that you need to follow. And just really, at the crux of it is that you're treating the corporate entity as a separate person, because that's really how the law sees corporations and LLCs, as people. And lastly, if you want to register your corporation, you actually go to hybriddriveillinois.com and you can do the registration for it. The actual filing is easy, but choosing the right entity is where you should get a professional. And again, I recommend both an attorney and an accountant. Mistake number 2 is creating the incorrect partnership documents, and that leads to disputes. So, like I said before, there are different types of documents for different types of entities. And, I had one time someone came to me and they were an LLC and they had a dispute, but they had something called an equity agreement, and that was the wrong type of document. And the reason why it's wrong is not just because of the title, but it didn't address all of the possibilities and the rights and the duties of the actual entity. In other words, so if you're an LLC, there's different rules about, what authority, members have. But when you have just this one-page document about you split the assets, you don't talk about how you're going to share your profit and losses, what happens if someone is married or divorced or passes away. And if it's if it's member managed or manager managed, if that's not all in there, you're going to end up having a dispute, and it's going to be very hard to resolve that dispute. So that's why it's very important to have the right kind of documents and just to really get to get a good understanding of what your business structure is. Another mistake is sometimes people don't even have documents. I know that might be hard to believe, but they go into business, they're excited, and and that's totally understandable. You might go into business with someone that you have known for a long time, maybe like an old, college roommate, and that you really trust this person. You think you don't need to have anything in writing. And those are the worst cases, because there was so much trust and now people feel so hurt and they don't have anything in writing about how they were to like do business, and it ends up becoming a he said, she said type of battle. And then another mistake is not using an attorney. And I know that sounds really self-serving coming from an attorney, but the reality is, like any of our, being a professional, like whether you are a mechanic or a painter, a doctor or a lawyer, a teacher, whatever it is, we all have our expertise, and asking someone to come and help you with something that you don't have any experience with, you're always going to gain that benefit. And trying to do it on your own, you don't have that experience. So I do always recommend that you use both like an attorney and an accountant. And just I really want to drive home the point that when you form a business, it's really more than just, oh, I'm going to fill out these documents, or I'm going to fill out these papers. It really is, I mean, like there's a strategy behind it. There's choosing the right entity, making sure that everybody has their rights and roles clearly spelled out in the right kind of document. Another mistake too is when people go into business, they don't outline the actual category of the monies that they put into the business. So like they say, okay, I'm just going to give $20,000 for my business, and then my business partner, Noura, she's going to throw in $20,000. Now we have $40,000, and it's not clear whether it's an investment and a loan. And there is I mean, these like differences are very important, because when you have an investment, you won't see that money back if if the business does not grow, or if the company is dissolved. I mean, that investment, it's a risk, and loans are risks too, but loan you can still kind of call back, and you can try to attach it to like as a judgment, or if there's a bankruptcy, like a creditor, like someone who has a loan, or that gave a loan, can still try to recuperate those funds legally. And so like if you go into business with someone, or even into your own business, so just by yourself, if you categorize it as a loan, it has to be clear. And you can do both. Like I could be a business owner and say, okay, I'm going to put $10,000 as an investment, $10,000 as a loan. I could do that even though I'm an owner. I can loan money to my business. Because what happens that you have these disputes, and someone will say, well, so-and-so stole this money from business, or whatever, or however they characterize those disputes. But if it's an investment, you really don't, you can't, I wouldn't bet on, expecting that money back, versus a loan, you can kind of claim it. Also with compensation is that's another mistake that I see a lot, with a lot of business owners, specifically when one business owner is doing a lot more work. So they say, so like if you have two people going into business, and they say we're going to split the profits 50-50, and one business owner is doing 80% of the work and still being paid the same as the partner who's doing 20% of the work, that creates a huge problem. And so what you can do in an LLC and a partnership is you can have profit sharing and wages and draws. I think people just see profit sharing, and they don't see that there are other ways to actually compensate yourself for the work that you do. And I think Noura might touch upon that later in her presentation. But it's very important to understand that as a business owner, there are multiple ways to compensate yourself, especially if you're doing business with someone else, so that you don't end up in a situation where like you're fighting with your business partner about who's getting paid what. And it's a very joint discussion between an attorney and accountant. I mean, you really can't do it with just one. The third mistake that I see a lot is with not understanding contracts. So it's important for us to know, well, what a contract is. You have offer and acceptance and consideration. Those are the three elements of a contract. It's very important to note that intent is not an element or not. So you can enter into a contract without really intending to, or knowing that you've entered into a contract. So that's very important when you are entering into a business relationship. You can't really say, oh, I signed this document, but I didn't know what I was signing. That's not a defense or an excuse to not following a contract. And all business, partnership agreements, those are all types of contracts. So the first contract myth is something called a standard term. So as with, business owners, like we hear this term a lot, like, oh, this is standard, just sign it, this is standard. But what like business owners need to know is that contracts can be freely negotiated, and to make the distinction between a standard legal term versus an industry norm. So you might have common practices. That's, I think, what people actually mean when they say this is standard, like, you know, everyone in the industry does this, but that doesn't mean that it's legally required. There are some required, like, I mean, you do have some exceptions to that, but 95% of contract terms can be negotiated legally. And the harm here is that people end up losing rights when they think that they can't negotiate their contract. The second contract myth is to believe that all contracts are enforceable. That's actually not true. Like, some people might say, well, you know, so-and-so signed the contract, so now I'm going to sue you and we're going to go to court and I'm going to have my day. That's not true. So first, it must be understood that if you want to enforce a contract, you actually have to go to court. That's really the only way that you can have a contract enforced. It's through a court, you know, order. And in order for a court to give that order to enforce a contract, the contract must be legally compliant and the court must agree with the language. So if your contract is vague or doesn't make sense, or it violates the law, court will not enforce it. And so it's really important. So two common examples of a non-enforceable term are like no oral modification clause. Mostly, not always, there are some exceptions, but when a contract says that this contract can only be modified in writing, in Illinois, that's not always enforced. You can actually modify a contract orally, even though the contract says that it can only be, you know, modified in writing. So that's something to be careful about. And of course, non-compete clauses are not always enforceable. There are certain, you know, rules that you have to follow to have an enforceable non-compete. So, you know, like, so the common mistake really here that business owners make is to not to think that their contract is, you know, just going to work just because, you know, they have it on paper and the parties have signed it. Lastly, I want to talk about the biggest negotiation mistakes when it comes to contracts and doing business. Negotiating a contract while doing business is a recipe for litigation. What I mean is that sometimes the parties say, okay, we're going to do business together, and but we did not agree, for example, on the price, who was responsible for what, and, you know, like all these other terms, but they start selling to each other anyway. So they're still negotiating, but also doing business. So if that contract is not ultimately signed, you can't necessarily just walk away and say, well, we never signed the contract, because your actions are saying the opposite of what the contract negotiation is. So that is still potential for a lawsuit. So it's important that you either are negotiating or you're doing business. You can't really do both at the same time. I mean, you can, but not without, you know, the risk. So at least know the risk when you do that. And so that's really important to have, you know, a lawyer come in and say, okay, you know, here's kind of where you draw that line between, you know, doing business and negotiation, and where that risk falls. And that's all I have. These are the common mistakes. And now I'm going to turn over the power of the presentation to Noura. She'll talk about the financial mistakes that people make. And I'm gonna.
Thank you, Danya.
All right.
Thank you, Danya, for the overview and for the introduction. Let me share my screen. There we go. Hi. So today I'm going to be talking about the financial aspects, financial mistakes that business owners make. Here are the three topics I'm going to go through one by one. The biggest one is going to be number one, and then I'm going to give you a solution, and then I'll go over the second 2 points. First one, biggest money blunders, like the biggest mistake business owners make. Here are the commingling business and personal finances. And Danya kind of touched up on this. Not only you can lose your formation, your rights on that, also you cannot report a correct taxes, a correct deduction. You may lose in deduction. I see a lot of business owners, they do spend a lot of money from their business account on groceries, on food, on so many, and even paying grants. And this is not okay. And it can like raise a red flag for what the IRS, and be audited and lose a lot of things that you might be able to deduct, but you cannot deduct just because you are commingling and you're not protected anymore. So when you do any business expense from your personal account or first, like, no, excuse me, from the business expense, never do anything personal. But if you happen to do any business expense from your personal, just identify if it was a loan or investment. Like Danya said, like you could claim it later if it's a loan, but if and you can reimburse yourself from your book, like if it's a loan, but you cannot do that if it's an investment. So just highlight that and make sure you record it in your books correctly so you can keep track of that. But never pay rent from your business. So or go get grocery. If you wanna, I understand you think it's my business, I can do whatever I want if you are a sole proprietor, but you cannot really, because you have to go just either like pay yourself first and then go spend the money. You don't or withdraw the money and record it as a owner withdraw. This way is okay, but you cannot do it directly from your business account or from your business credit card. Then not planning for upcoming tax obligations. A lot of business owners, they don't know they have to pay estimated taxes quarterly, because when you are an employee, your employer withholds your taxes and they pay it in a either monthly or quarterly basis, but they have to file it for it like quarterly basis. But when you are owning your business, there's no one to do that for you, so you have to do it for yourself. So a lot of business owners, they don't really know like they have to do that. Make sure you consult with your accountant or learn about it yourself if you don't want to like have someone, but I always recommend to consult with an accountant on tax issues so you can at least know how do you account for this. Fourth mistake, not setting a budget for your business. And when you have one, you don't stick to that budget. Always like a lot of business owners, they don't really set a budget and they just think if they have cash in their bank, they can spend, and then later on something comes up and they cannot cover it. To avoid, like you have to set a budget for yourself and stick to it. Like, so, you know, like sometimes it's a timing issue. Like you might cannot invest on that thing for now, but you can invest like 2 months later or not until next year. So you have to know how much you can pay and when in order to keep yourself in business and keep your business profitable. Also, like a big mistake is thinking bookkeeping is a luxury. So bookkeeping is recording everything that you spend for your business, like investing in your business, giving loan in your business, spending on advertisements, spending on your work location rent or anything for your business. Like you have to record every single thing, even like having software, everything you have to record for it, every single thing. And you have to keep record, like keep the record the way you would like to keep it, but just keep it and keep all your receipts, because this is you staying in compliance. So if you don't have a good record keeping, you cannot really claim the deduction you're entitled to. You cannot have an accurate P&L statement. Then this will prevent you from taking advantage from a lot of things. Like you cannot buy a house because you cannot prove like you're making money. You cannot take an advantage of any loans available for you. We saw that a lot with the PPP loan. A lot of people, they couldn't take advantage because they didn't have a proper bookkeeping. They would just like commingle numbers and like just estimate how much they spend, and they might have missed something that from their revenue or from their expenses, and they cannot come up with with the correct number. This way, like you cannot get everything you're entitled to, or you may take something more than what you have. Then you will face a problem later. So it's really important to have like a proper bookkeeping. Not paying yourself correctly. This is tied up to the business formation. So every business formation is different. For example, LLC, you cannot pay yourself salary. You cannot put yourself on a payroll. You have to take an owner withdrawal. Either like write a check to yourself or send it, just wire it, but keep track of it. This is an owner withdrawal. This is your income from your business. For example, if you're S corporation, an S corporation, you have to take wages. You have to put yourself on the payroll. Even if it's only you have to put yourself on a payroll, because S corp is a pass-through entity. It's just like telling the IRS, this is how I want to be taxed. So it's a tax benefit, but not everyone has to be an S corp. Just like it's different for everyone. Like Danya said, you have to consult with your lawyer and accountant to see which one is the best for you. And sometimes you would be an LLC, you would start an LLC, and then later on, when you make a certain amount of money, and you see, okay, now it's more beneficial for you to convert to S corp. So it's just like case by case, and you really have to consult with a professional, both attorney and accountant, to see what's most benefit you. Payroll mistakes. Payroll mistakes, like when you're ready to hire, like this happens more like when you have a store or, like somewhere where you really need help in a daily basis. So you hire in the beginning or whenever you're ready to do that. A lot of people just write a check for their employee or just like transfer money to them without withholding taxes, without paying taxes, without doing anything, just paying money. Like this way, you will be paying a lot of money later on, because when you have the person working with you, you are responsible for withholding the tax, not only for yourself, but also for your employee. So you have to withhold the correct amount, and you have to pay for your state and for your for the IRS in whatever you are entitled to. Like sometimes if you pay payroll bi-weekly, you have to deposit the money bi-weekly so you don't incur any taxes or interest. And then you have to file a quarterly payroll taxes. And then at the end of the year, you have to file the annual payroll taxes just to make sure you did okay and you paid everything you have to. And if the government owe you something, so you can get that back. And also the biggest mistake on that, not only just paying randomly without withholding, what I see a lot of people do, they just say, oh, it's easier to put people on 1099, while really they cannot. They cannot do that, because they will be facing penalty and a lot of consequences, since they have to put that person on W-2, not 1099, because if you control where the person does the work and how to do it and when, then he or she is W-2. So there's no way for you, like you cannot put them on 1099. But for example, if you have someone, you hire someone to take care of your social media for you, and you don't want them to come in, you don't care when do they do their job, just like you give them a project-based thing, this person can be on 1099, and you don't have to worry about like withholding taxes. They will be responsible for doing that for themselves. But you cannot put someone who comes to your store and be a cashier, for example, and you put them on 1099. This is a big no-no. Filing taxes for your business without proper bookkeeping. This is also first, like, how do you bring your number? There's nothing. You might be losing a lot in deductions. You might, because not everything's treated equally. There's like expenses it can be deducted from the revenue, but other expenses can be partially deducted. For example, like meals and entertainment used to be like 100%, or used to be 100% deductible long time ago. Like now, like entertainment is not deductible. So whatever you do, it's not deductible from your business taxes. And meals is 50% for 2020 deductible, but business meal is only qualified if you go with a client or prospect client. You cannot deduct business meal if you just like go have lunch every day. Like this is not okay because you cannot deduct it. Now only for 2021 and 2022, you can deduct the business meals for 100% just to, you know, for restaurant business to get back on their feet. They did this. I don't know if, who knows, like if they will continue this or not, but this does not apply for 2020. So you really have to keep a proper bookkeeping, because if IRS flagged your tax return for audit, like you might lose a lot of things. You could be deducted. You have to say like, who did you go to, who did you go with, and why. You cannot go with your daughter or your husband or your wife and say, okay, just having a family dinner and put it on your business. This is a big no. You might not be caught, but if you are caught, like you lose a lot of deductions. Like you might lose other meals where you took clients, where you did anything for your client, and you cannot deduct it because you did something wrong. So you lose a lot with this. So please keep a bookkeeping, good bookkeeping. Even if you don't want to do it yourself, just do it like Excel sheets. How do you want to do it? Just do it and keep all your receipts, keep all your documentation. Just protect yourself. Not closing your business properly. This mistake, like if you decide you don't want to like continue with the business, it's not profitable, I don't want to do it, or you want to move, or whatever you have been, like you just don't want to continue with this business, you have to make sure you speak to your attorney and the accountant and make sure you close it properly, so IRS or the state authority don't come behind like to your door like a couple of years later saying, oh, you owe us this money, because they will estimate how much you owe them. And then it's going to cost you a lot of money just to prove that your business was closed and you didn't have any payroll and you didn't have any income tax. So make sure you do everything you have to while everything fresh on your mind, and consult with your lawyer and accountant to see how should you close it, like in both sides, like IRS federal side and your local authority side. So now how can we avoid this mistakes? Like there's like 4 things like you have to do, mainly to avoid everything I spoke about. Open a separate bank account. This is like a big thing. Like this is what you start your business. Even if you did not have a business register and you don't have EIN number from the federal, because if you don't know, EIN is the identification number that replaces your social security and that identify your business. And if you're not forming your business and you're just independent contractor, just have your separate bank account, like even if it's a personal, and because you don't have your business, so you can, because you have to really do everything financially for tax purposes, even if but you don't have the protection, of course, but you still have to do it. Just separate the funds, separate the account. And if you're a business account, as soon as you get the EIN letter from the IRS, go open the account, the business account, and start spending money from it. I understand sometimes like when you start your business, especially if it's a service, you might not have enough money to pay for everything. And like, because your business is you, like you're providing the service. So you're waiting to get paid, but you cannot get paid until you do a lot of things before, then that's okay. You can just spend your money from your personal thing, but keep track and identify it in your books if it's a loan or if it's an investment. Like I said, if it's a loan, like you can take it, you can reimburse yourself and just record it properly on your books so it can show that way. Second thing, keep track of business expenses. Oh, I already spoke about this one. Keep track of your business expenses. Record every single financial transaction and keep receipts. The requirement is to keep receipt for $75 or more, but I would recommend actually is keep every single receipt and document every single thing. Like if you can do that daily, please do that. If not, at least do it weekly so you don't forget. Take a picture of the receipt in case like you're probably gonna lose it if you don't take a picture. If you're using QuickBooks, it's a great tool because they have an app, like you can just snap a picture and they can like extract the information from it, and it's really easy. If not, like just keep the file, just do whatever works for you, just keep the records and make sure you know everything. If you're traveling in a business trip, then you can deduct the meals, you can deduct the airfare, you can deduct any cost, but keep emails, keep registration in a conference, for example, keep the purpose, keep like everything that prove that was a business expense, because I've seen people travel on their business expense for personal things. But for example, if you spend more days in the business trip like that for personal, you can just claim the percentage that was for the business. But you can do the airline because you were gonna do the airline anyway. But for like hotel expenses, like meal expenses, those you have to take care of them personally, but only the days you spend for business, those are the eligible ones to deduct for tax purposes. And then lastly, when you dissolve your business properly, just talk to your accountant and your lawyers to see how can you just free yourself from the business so you're not, no one comes to you in a couple of years with a big bill of tax. Now, like a lot of business owners like have a cash flow problem, and you really have to identify where is the cash flow problem come from, so you can continue in your business and you can be profitable. And again, proper bookkeeping is the best thing, best to help you identify where the cash flow problem come from. Like it can be from payables. Payables is when you get a bill and then you have to pay it. A lot of people, you might be doing like, okay, I'm gonna pay it now. Even if it's not 30, you have like 30 days to pay it. While on those 30 days, you could have like a lot of other responsibility and you can do more business, but you just don't want to forget about it because you don't have a system to remind you that something is due. So you just like want to take care of it right away. Like you might have to change that and just take your time and develop a system. Like if you use the software is the best. Actually, there's a lot of softwares, but I do recommend QuickBooks because QuickBooks really it's easy to give access to your accountant if you decide to hire one later, and it's easy to switch between an accountant and another accountant if you're not happy to working with someone. So a lot of people use it. Like other software, well, it's going to be hard sometimes to find someone to work with the other softwares. But whatever works for you, whatever feels it's okay, just keep track of this and have a system. So because payable is a big part of the cash flow issue, or sometimes you pay late and then you have an interest on late fees. You're paying so much more money for the things you get because you forgot about it or something. Receivables is like when you sell your goods or services to others and then you don't get paid. Sometimes I see people like they miss payments because they are so busy doing service and they forgot. They might not invoice people. They might give like a credit for people who they're not gonna pay later, net 30 or whatever. Like you have to have a system to see if you can like credit check system or something that to see if you can give a credit for that person. And if your business is not in a position yet to give credit, just don't give a credit. Just get paid right away and don't forget to invoice people. Just put that system in place, and whether you have to do it yourself, whether you have to hire someone in person or outsource, but even if you outsource or have someone in there, like the person who does the sale has to have a system to inform the other people that he did the sale, so it can be taken care of, and so you can avoid your cash flow problem. Third issue, like it can come from inventory. I know sometimes when you buy in bulk, you think you're saving a lot of money, so you want to buy more, but sometimes like you cannot really buy more, and then your inventory goes bad, or you are forced to close the business because you cannot run it anymore because you spend all the money in the inventory. So just make sure you're measuring your inventory correctly. You have a system to see how much exactly you have to get and how often, so you don't run low on your inventory, and also you don't have to have you know, place to store it, or like to just have tight cash flow just because you got so much inventory for like small savings, then it will cause you a lot of problems after that. Hiring. When you have to hire, make sure you hire on a good time, on the right time. That comes from planning, budgeting, see how, tracking yourself, tracking your taxes, tracking everything in your business. And you don't have to hire a person in-house. Like any like office work, sometimes like it can happen, you know, with outsourcing. You can have a temp employee, like seasonal employees. Like you don't have to hire right away, but when you hire, make sure you put your employees on the right payment form, 1099 or W-2, based on the description. How do you want them to work, to do work, and make sure you are in compliance with that. How your business can save on taxes. Taxes, one of the biggest expenses from business owners. So make sure you plan for it, right? Make sure you have the correct business formation for tax purposes. Again, this is something you have to talk to your lawyer and to the tax professional or accountant before you form your business, to make sure. And also you have to continuously, as you grow, to consult with the lawyer and tax professional to see if this business formation is best for you or not. Like they will sit with you, see your goals, what you want to do, what's your vision for later in life, so they can advise you on how to form your business. Pay the correct quarterly estimated tax to avoid interest and penalty. A lot of us, like, we don't think about tax until the end of the year. I think, oh, okay, well, I don't have to worry about any of that. But no, when you are a business owner, you have to worry about taxes every day. So make sure you file your quarterly estimated tax. And when you do a good bookkeeping, then you know how much you pay. Don't pay estimated taxes on your revenue, because this is not how much you make. It's going to be your revenue minus the deduction, minus your expenses. That's going to be your take home. And that varies between S Corp, LLC, or whatever it is. So it's not the same. So you have to consult with a professional to see how you pay this. Manage your business in continuous tax planning mode. Again, like, you have to think about taxes every day. Don't be reactive. Be proactive with taxes, so you can pay less taxes legally, and you can time your purchases. You can time your everything you want to do, so you can have the most benefit from business and to pay less in taxes legally without getting flagged, without getting IRS on your back. Go to your accounting to design a tax saving plan. Tax planning is a thing, like it's entire, it's the entire service, like so accounting firms can do, accountants, bookkeeper, they can do for you, tax professional, they can do for you. You just have to talk to one and see how can you save, and you have to have like few meetings with your accountant, or like maybe there's a questionnaire, and you have to meet and explain everything in your personal and business issues, so they can advise you the best. They can tell you how can you save on taxes, how can you owe $0 in taxes with staying in compliance, if possible, of course. So just be always in continuous tax planning mode. And that's it for me. And here's our contact information. I do have a sheet that I have it here, business prep tax prep checklist that you can download, and it can help you with tax planning. If you want to start this way, go ahead and start this way. Here's my website. Also, like, you can go to the website and do a free, schedule a free consultation, or we can talk and can see if we can be a good fit if you would like to. or just speak to your accountant and lawyer. I'll leave it to Danya now, like to talk about her contact information.
Thank you, Noura, so much. That was a great presentation. I know that even as a business attorney, I learned a lot about probably some mistakes I've been doing in my own practice from a financial perspective. As you can see here on the screen too, I have my phone number and my website and my email, and I have a free resource as well. It's the 5 W's of contract negotiation: the who, what, where, when, why, and how. So you can go to tinyurl.com/5WS contract. And of course, you can follow us on our social media on Facebook and YouTube. I'm always posting videos just answering a lot of legal questions that I find in my own practice. Does anyone have any questions? If you are in the Zoom, you can put your question in the chat. And if you're on Facebook, you can throw a comment. And while we're checking for those, I can see that I really want to just actually really comment specifically, Noura, about what you were saying about misclassification of employees. I see that so much when I have clients who have independent contractors. Often when I ask them, why did you classify them as an independent contractor? And they'll say something to the effect of, well, it was just a hassle to deal with payroll, and I don't want to deal with all of, tax, payment, and do I have to give them these benefits? And, and that's when I step in and I explain, unfortunately, it's not the employer who decides whether a person is an independent contractor or an employee, it's the law. And so then that's very important too, because when you misclassify those employees, not only, is the business subject to, like the financial, burdens and the tax issues that they might run into with the IRS, but also legally, they are going to open themselves up to like wage claims for, not paying minimum wage, or not paying in the right, timeliness, like you have to pay every 2 weeks. And actually business owners sometimes can be personally liable for some of those claims against them, and businesses, and then that business protection won't apply there. So that's very key, and I'm glad that you brought that up. So I don't see any questions. So in that case, we'll end right there. And thank you again for attending and watching our video and our presentations. And again, if you have any issues, feel free to contact us. We're also, if you're watching this on YouTube later, we are going to put those links in the description below. Thank you.